many people are aware of it subconsciously, intuitively in their gut, but don't deal with the issues that arise from it. And we believe that it's an opportunity to start talking to clients and engaging with them on long-term care. In the marketplace today, you know, if you're wherever you are, you know, there's people out there doing seminars. There, you know, the Social Security seminars, annuity seminars, retirement planning seminars, trust seminars. In my area, and I'm in Scottsdale, Arizona, and you know, this is prime country for the elder planning marketplace. I'm not seeing anything from anybody with regards to long-term care. It's, you know, it's one of those things people don't like to talk about. What's the opportunity? First off, you know, in the past 2 years, the government seems to be putting up headwinds for financial advisors with regards to the regulatory environment, with regards to the interest rate environment, with regards to the compliance environment. It's a strong set of headwinds that we've been facing, and it's created a lot of uncertainty in our business. Long-term care is one of the issues or one of the planning solutions where the government has our back, and we're going to cover in greater detail what that means and why I say that. But the government knows that people need this planning. The government knows they can't afford it. In the health bills that are going through Congress right now, you know, they're talking about cutting Medicaid funding. 40% of all long-term care, and I mean, actually the statistics is in here. The single largest provider of long-term care expenses is the federal government via the Medicaid program. And they're going to be cutting Medicaid one way or another. And that's the proposal. And the government wants people to do this. When the Affordable Care Act first came out, they tried to build a long-term care solution into it where everybody would have to contribute $25 or $50 a month, and there'd be some, you know, basic long-term care program in place, but the actuaries couldn't make it work. They just could not make the math work. There's substantial tax benefits and tax strategies where the government's saying, please, you know, here, if you're buying long-term care, we're going to give you every opportunity in the world to do it with pre-tax dollars, and we'll go over those solutions. But overall, the presentation that we're doing, we have beta tested this locally here in our market to retail clients. The responses are overwhelming. When we present to people the concept, we're getting requests for appointments. The ratios are in the 60 to 65% of the people who attend the seminars want to sit down and have a follow-up conversation. So that's the opportunity. This presentation is available. We'll make it available. We can customize it for you. Several of our broker-dealer relationships have already pre-approved it. And again, every time we've done this, we've gotten a very favorable response. So I'm going to go through the presentation as if I were presenting it initially to the end user consumer, and also interject throughout the presentation our opportunities as advisors. Our agenda today is talking about living a long life, addressing key questions with regards to long-term care, define what long-term care is, what are the risks, protecting relationships. One of the number one issue for people going into retirement is, do they have enough money? Are they going to outlive their money? The number two, and sometimes it's number one, is they don't want to be a burden to their family. And we're going to address that with regards to protecting relationships. What does it cost? Who pays for long-term care? What are the favorable tax treatments that I discussed in my opening? And what are the types of long-term care plans? Long-term care has evolved dramatically, both good and bad, over the last 5 years. And we're going to address what all of the current options in the marketplace are with regards to product design. Living a long life. Considering if you had all the time in the world, how would you want to spend it? Most of the most common responses are they want to spend time with their family, spend time volunteering, enjoying hobbies. Life expectancy at age 65 is age 85, 21 years. That's off the IRS Table 5 table, and that is also a statistic that most of the insurance companies use. For a couple age 65, there is a 50% chance one will live to age 52 and a 25% chance one will live to age 97. Unfortunately, when we live a long life, we may need long-term care. It increases the odds that you're going to need long-term care in the future. Questions. One of our relationship managers, Dale Phillips, came up with some of these questions. He had intimate sessions with clients where they sat down and talked about these issues, and these are some of the questions that had come out of that. What kind of health conditions do you or your spouse have that could affect your health and how and where you live in retirement? Are they chronic, and how do they affect your life? Thought-provoking questions when we're doing the seminar. And we don't sit and wait for people to answer. We're planting seeds for them to contemplate in the seminar scenario. Where can I get long-term care services? Long-term care is the extra personal assistance you may need to maintain your quality of life. Most long-term care needs are met in the home, and there's a progression. And then some people move into assisted living communities. There's an interim step between home and assisted living, or combined with assisted living, of adult daycare facilities. I have an uncle who is currently has cognitive impairment, and they're trying to find an adult daycare facility that can take care of him. And then you progress to a full-service skilled nursing home facility, and then ultimately hospice care. And again, most long-term care policies do provide hospice care benefits. So it's a spectrum of needs and a spectrum of locations where those services are going to be delivered. What kind of housing options have you considered for when you no longer have the desire or ability to live at home by yourself? And again, a lot of people, their number one response is, I don't want to be a burden to my kids. So what are their options? Have they given it any thought? And then ultimately, have you figured out how you're going to pay for it? What is long-term care? The care you need when you are no longer able to care for yourself independently, because you are not able to do some of the basic activities of daily living. An activity of daily living in ADL is a defining term with regards to qualifying for long-term care assistance from policies. Surprisingly, a substantial portion of people in long-term care are people under the age of 65 because of accidents and chronic illnesses. But primarily, long-term care needs are generated from accidents, chronic illnesses, aging, strokes, and severe cognitive impairment. The cognitive impairment, the dementia, the Alzheimer's, that spectrum of cognitive disorders is mushrooming as our population ages. What are the activities of daily living? Dressing, eating, bathing, toileting, transferring, incontinence. You need, and in most cases, you need to have assistance with 2 of the ADLs to qualify for the benefits on your long-term care policy. What are the risks? Most people are planning to live a long life. Most people will, short of an accident. Life expectancy at age 85, the definition of that means that 50% of the people that were born in the same year, 50% of them will have passed away by age 85. 50% of them would still be alive. That's what a life expectancy of age 85, what that means or what the term means. You and your loved ones need long-term care that could affect your lifestyle, your retirement, and your life's goals. In the year 2020, some 12 million Americans are expected to need some form of long-term care. And because women generally outlive men by several years, they face a 50% greater likelihood than men of entering a nursing home after age 65. At least 70% of people over the age of 65 will need some form of long-term care services. 3.9 years is the average length of long-term care claim, lasting longer than 1 year. And it's 4 to 8 years is the average life expectancy for people with Alzheimer's disease diagnosed after age 65. And sometimes they can live 10 to 12 years. And we talk to people, look at the health history in your family. What is the history of longevity in your bloodline? And does this align with your expectation of your health and personal activity? Again, one of the better indicators of your life expectancy and the type of life that you're going to live in as you age, you can look at your parents and your grandparents. How long did they live? How long did they live with a quality of life versus how long did they live as an invalid or needing a substantial amount of assistance? And again, those time horizons expand. Life expectancy today is a lot higher than it was even 30 years ago. Protecting relationships. Again, most people that we speak to, they say that the one thing they don't want to be is a burden on their family, either financially, time-wise, or just generally taking up from their children and their grandchildren's lives to take care of them. And 46% of family caregivers report that providing care affected their personal health and well-being. And if you think about it, how couldn't it? If you all of a sudden you're living your life and all of a sudden you now have to take care of your parent, I mean, it's going to take up time, it's going to take up resources, it's going to take up money. 53% of caregivers report that they lost income due to the demands of providing care. Sometimes people have to quit their jobs. You know, you've got a family where the husband and wife are working and they've got to provide long-term care, and one of the spouse's incomes is less than what it would cost them to provide long-term care. Well, guess what? That one of those people is going to quit their job and provide long-term care. And nearly 50% of caregivers experience a negative mood, including depression, mood swings, or resentment. And again, taking care of someone that is an adult and is now in need of assistance with the activities of daily living, it can wear people down. What kind of support, financial or caregiving, are you providing for the benefit of your spouse or another adult? When we're in these seminars, a lot of the people that we have found that come to the seminars for us, they're there because they have a parent or they have someone in their lives that they are taking care of or had to take care of. And they're there to find out how to make sure that doesn't happen to them and their children. Protecting your relationships to hidden costs. Women live an average of 5 years longer than men. Women who provide unpaid care lose an average of $565,000 in income in retirement benefits over their lifetime. That's from an article in the Minnesota Women's Press in November of 2013. It's lost wages, it's lost contributions to their retirement plans, matching contributions to their retirement plans, and the deferral and growth on those assets had they been continued to work and were able to continue to accumulate wealth. 75% of unpaid caregivers are women. 40% of seniors caring for a spouse will predecease the spouse they are caring for. What happens then? If there's no other support network and the caregiving spouse predeceases the spouse in need, what then? Family caregivers are well-intentioned but ill-prepared. Nobody's teaching people how to take care of someone in their family. You know, many of us have children, we raise children, we know how to take care of children. Taking care of a full-grown adult is a whole other ballgame. Nobody's taken any classes or training to figure out how to do it. Women are affected most by the impact that long-term care can have on a family. Again, most women are the caregivers. 75% of unpaid caregivers are women. They're dealing with most of the effort, most of the work, and it affects them the most. Men feel the impact as much as women when it comes to the financial preparing for their future health care. I mean, the financial aspect's the same. It doesn't discriminate between male or female. But again, the burden of the labor in our culture and in our society is falling to the women. Long-term care and women. In all 5 sectors, the users of long-term care services were overwhelmingly women. Adult daycare, 59.6, home health care, 62.7, hospice, 59.7, nursing homes, 67.7, and residential care communities are 72% women. What are the overt costs? Or just what are the financial costs? Again, there's the psychological cost, there's the lost opportunity cost, there's the lost wages, loss of lifestyle, but the actual costs. Home health care, 51% of all long-term care services are provided in the home. In 2016, the average nationwide, and it varies greatly by state, and we have a calculator on our website. If you want to go in and click on that calculator, it can show you state-specific what those costs are. But in 2016, it was $49,204. So let's say, can your clients afford an additional $4,000 a month outlay in retirement to start paying for home health care? In 2030, it's going to be $85,782. Folks, that's only 13 years away. Community care. Once admitted, the average length of stay in the U.S. is 2.5 years. 2016, it was $47,000, and in 2030, it was $83,000. It will be $83,000. Nursing home. Long-term care claims are growing in length. 15% of claims last year over 5 years versus 4.5 over 5 years 10 years ago. So it's more than tripled the number of people that are facing greater than 5-year claims. So when we're doing this planning, when we're trying to pick durations, something to keep in mind. And again, nursing home care today in a full-skilled nursing facility is $90,520, and in 2030, it'll have inflated to $177,000. A lot of the disruption in the long-term care business is because of two factors. One is low interest rates, but two, the fact that medical expenses are inflating at a rate substantially greater than the rest of the economy. Have you planned for any of these issues that could affect your retirement plans or goals? The simple question, have they done any planning? Have they had a conversation with their advisor or anyone else? What steps have they taken, any conscious steps that they've executed to try and deal with this situation? When I'm in the seminar and I've got clients sitting at the tables, we set it up classroom style, and I say, look left and look right. 2 out of the 3 people are going to need some form of long-term care assistance after the age of 65. A lot of people are betting, if you had a 2 out of 3 chance, people buy car insurance, hopefully their chance of having an accident over a 10-year period of time is substantially less than 67%. Same, people buy health insurance, or at least some people do. It's not a question of when you get sick. It's not a question of if you get sick, it's a question of when you get sick. It's pretty much like that with long-term care. You might be the lucky one that doesn't need it, but the odds are against you. Who pays for long-term care? Medicaid pays 40% of all costs. That's in the current situation. The baby boomer cohort is just now starting to cross over in mass over the age of 65. And Medicaid is already under stress. I mean, again, the conversation in Washington is about cutting Medicaid substantially by as much as 40% over the next decade. Where are the funds going to come from? The government can't really afford it. But to qualify for Medicaid, you have to have less than $2,000 of accountable assets, and those liquid assets, before you will qualify. So basically, your clients have to plan on being destitute before the government's going to step in and assist them. Now, there's some nuances to that, but really, there's not a lot of wiggle room, and the states which primarily administer Medicare are getting more and more stringent with regards to what you can do to get that to shelter assets. So we have clients come in and say, "Oh, I want to do Medicaid planning." Our response to them is, "Listen, we're wealth advisors, not poverty advisors, because really the only way you're going to qualify is if you eliminate all of your assets." Who pays continued? Long-term disability. Long-term disability covers loss of income. And most disability policies stop paying after the age of 65. Some go out to 67, and there's some specialized products where you can even extend it past 67. I'm going to tell you, when you get past 67, it becomes cost prohibitive. Medicare. People mistakenly think that Medicare is going to cover long-term care. what Medicare covers is Medicare will cover the first 100 days, and that assumes that you, prior to being discharged to a skilled nursing facility, you spent 3 midnights in the hospital, and that your discharge is directly related to the reason you were in the hospital. So for the first 20 days, Medicare will pay 100% of those costs. Then for the next 80 days, there's a $165 a day deductible. On day 101, Medicare's done. They're not going to pay any more. And if you're in a skilled nursing facility and you have not made arrangements for how they're going to get paid, they will discharge you. It's big business. Health insurance does not cover long-term care expenses. Medigap policies are health insurance policies. Most Medigap policies will cover the $165 a day deductible for the first 80 days, but again, on day 101, they will not pay for anything that's deemed long-term care needs, like the bed, the food. They'll still pay for the medicine and the medical aspects of whatever the situation is, but they will not pay for the long-term care, whether it's home health care, assisted living, skilled nursing care. They don't pay any of it. Self-insurance. Well, this is what most people do. Assets used to pay for long-term care can deplete future income for your spouse as well as drain the inheritance you plan to leave your family. For the person that's on the long-term care claim, it's about the survivor, because if and when that person dies and the other spouse is still alive, what's left for the other spouse to live on? If they've been shelling out $40,000, $50,000, $60,000 a year in additional expenses for long-term care needs. The next one is family members. Even the most responsible are not always prepared physically, emotionally, or financially to care for loved ones. 53% of Americans who cared for a loved one lost income due to demands of providing that care. It's the overt starting to pay the expenses for mom and dad. It's the lost income, the time off work. And I'm in that sandwich generation, taking care of my child and taking care of my parents. And I have to tell you, the past year, I've missed some time at work taking care of, assisting my mother with some of her needs. Sit there and ask yourself, have you missed any days of work? Have you missed business opportunities, revenue generating opportunities, because you've been focused on taking care of your family? What type of insurance have you considered when you leave the workforce, or what type of insurance do you have now since you have left the workforce? How familiar are you with Medicare, what it covers, when and how you should enroll? Again, these are questions to ask, to generate thoughts, to have people start making notes after the presentation. Private long-term care insurance. Private long-term care, only 9% of long-term care expenses are paid for with private long-term care insurance. So, you can say, okay, not very many people are buying it, therefore, tough market. Or you could say, 91% of people don't have it. There's a tremendous opportunity to go out there and start talking to people and discussing this solution with them. Private long-term care insurance avoids physical and financial dependence on family and friends. It protects your hard-earned assets. It maintains choice in how and where you receive care. Let's take a step back to the Medicare or Medicaid. Medicaid decides where you're going, you don't. The Medicaid facilities rank from the mid of the pack to the bottom of the pack with regards to quality of life, quality of location, quality of care. And you don't get to choose. There's in Arizona, every once in a while we'll read a story where a husband and wife both need long-term care, and they've been married for 35 years, and they get split up and go into separate Medicaid planning facilities, and it happens. You don't have choice when you go into the Medicaid system. You can assure high-quality care at an affordable price. Again, most facilities love private long-term care insurance. You can also stay at home when you need care. Almost all long-term care policies issued in the past 10 years have home health care, whether it's a 50% or 100% match to the daily benefits on a traditional long-term care. The providers, the long-term care providers, would rather you stay at home longer because it's cheaper, and there's a greater chance if you're at home, they're going to have to shell out less on that policy claim than if you go into some type of a facility. And primarily, you get to maintain your independence. This, again, think of your clients, the conversations you've had with them. As they go into retirement and as they age, they want to maintain their independence. They do not want to be dependent on, it's not only do they not want to be a burden for the sake of their children and their grandchildren, but they want to maintain their independence for the sake of their quality of life. Favorable tax treatment for long-term care payments. Again, this is one opportunity. First off, long-term care is an insurance product. It's a fixed insurance product. You can't fund it. Well, there is one opportunity to fund it with qualified plans, but generally speaking, you can't fund it with qualified money. So it doesn't come under the purview of the Department of Labor rules that we're facing with regards to retirement accounts. 2, it's regulated at the state level, not the federal level. So even if the Department of Labor decided that they wanted to make it an issue and try and regulate it, they don't have the regulatory authority. It's done at the state level, and the state insurance commissioners, which have they have a consortium called the NAIC. That's where the rules with regards to this are. And again, the states really are the ones paying Medicaid and really are the ones administering these programs, and they want people to buy long-term care. So from a regulatory perspective, there's not a lot on the horizon. I mean, there's a lot of continuing ed we have to do, a whole lot of disclosure, and you have to address the senior planning issues. But overall, we don't face the same regulatory risk that has taken place with retirement plans. And again, I'm all for providing the best solution I can for my client every time. That's not the issue. We've always operated with that standard. It's just, with the DOL rule, there might be a little bit of overreach. And we don't face that risk as much in the long-term care marketplace. And the government's providing tax treatment. They want people to buy it. So we're going to go through what all of those tax treatment issues are. 1, long-term care premiums count as a medical expense, and it's deductible to the extent that the other medical expenses are deductible. So once the amount is in excess of 10% of AGI, you can deduct those expenses in excess of that dollar amount. So if you have a client that's got an AGI in retirement of $50,000, they have to exceed $5,000 here in expenses. Their long-term care premiums can count towards that and help them get to the point where they can deduct additional medical expenses. If you're self-employed, 100% of the premium is deductible. There's no 10% threshold to meet as well. And you can also deplete as a dependent. Now, with regards to that, the IRS does publish tables that says at a given age, here's how much will allow you to deduct. So the premium you pay may be in excess of what the IRS is publishing on an annual basis. So if you're younger, you may be paying a higher premium than you may not be able to deduct the full amount, but there is a deductible component to that premium amount. Partnerships, LLCs, and subchapter S's. Unfortunately for the owners, it's the same as if they were self-employed. But they can provide long-term care benefits to their employees, and it's 100% deductible to the business entity, and there is no imputed income to the employee. So the employer can provide as an additional benefit, fully tax deductible, not reportable to the employee, long-term care policies. And there's been developments in the marketplace from a provider out there where short pay, 10 pay, pay to 65, and single pay long-term care products have become available. And you could potentially provide an employee a paid up contract over a short period of time prior to retirement and deduct the premiums. C corporation. 100% of the premium is deductible to the corporation, and the business owner is treated the same as if they're an employee because it's not a pass-through entity. So if you have clients that have a C corporation, they can purchase long-term care through that corporation and fully deduct the premium. And it's not subject to non-discrimination rules. The employer can be selective as to the employees in the plan. They can do a key executive plan. They can do there's a lot of ways that you can segment so that you're not, you say, okay, we're only going to do it for people over age 50. We're going to do it for people, whatever. There's a lot of flexibility for defining what that group looks like to be able to deduct those premiums at the C Corp level. So the business owner can get it pre-tax from the corporation. Corporation gets the deduction provided for the employees. It's a great benefit. In the Pension Protection Act of 2006, they passed a rule that said that dealing with annuity gains, you can access gains in an annuity contract. If a client had put $100,000 into an annuity and it's currently worth $200,000, they have $100,000 in gains. If they start taking withdrawals out of that annuity to spend the money, they got to pay taxes on the gains first, and then they get their principal back, assuming that they're just doing withdrawals. But if they take the withdrawals out of the annuity to pay long-term care premiums, the distributions are not deemed taxable. And there are annuity contracts as well where you can take money out, gains out, just to pay long-term care expenses and not be taxed upon it. So again, it was in the Pension Protection Act. So the deferred gains can be leveraged and accessed income tax-free to pay long-term care expenses. So now there's a stipulation. It has to be a product that qualifies. There's some, and quite frankly, the distinction between one that qualifies for this treatment and one that doesn't, I don't know. It's just it's something they added to the contract in the language. But you know, many carriers have issued contracts or come out with contracts specifically focusing on this opportunity. So to determine if you've got a client with gains and they've got an annuity, you need to research it first before you start taking out distributions, see if the distributions from that annuity will qualify for the tax-free distributions to pay for long-term care needs. There's multiple solutions. Traditional long-term care insurance. This has been around since in the United States, it's been around since 1973. I believe that's when the first true long-term care policy was issued. There's a lot of issues with traditional long-term care, and we're going to get into those in a little more detail as we go through. There is accelerated benefit riders for long-term care services. If you have a client that has a need for life insurance for whatever reason, you know, they're trying to maximize their estate to maximize what they leave to their heirs. They want income protection for their spouses. For whatever reason, they buy life insurance. You can add a rider that will act as an accelerated death benefit on the product, and some of them are actually true long-term care benefits, where they'll accelerate the death benefit at a rate of 1%, 2%, 3%, or 4%, or some of them will do it just based upon the HIPAA standard, you know, whatever the published HIPAA rate is. So you can get that benefit accelerated, and those distributions from the policy are income tax-free because they're considered accelerated death benefit. Death benefits are income tax-free. And it doesn't add a significant amount of cost to the policy. So when you run an illustration with and without the long-term care rider, the difference in performance is not that substantial. It's certainly relative to the benefits that you're getting, it's worth it almost every time. And we typically like to show, hey, here it is with the long-term care rider as well. You really should consider this. Then you have the linked benefit products. This is the MoneyGuard, the Care Matters. You know, Pac Life has one, Minnesota Life has one, the One America product suite. They have several products that address this issue. And these are life insurance policies. They're universal life policies or whole life policies, but they're really not designed to maximize the life insurance component. They're designed to maximize the long-term care component. And again, these things can be single pay funded, short pay funded, 10 pay funded. So traditional long-term care, what are the pros? Spousal discounts. You can get discounts on your premiums of 10 to 30%. Inflation protection. Premiums may be deductible. And you can get asset protection in most states now with a partnership program. A partnership program says you buy a pool of long-term care benefits. Let's say it's a $250,000 pool, and the states will determine what the minimum daily benefit is, what the inflation benefits must be. And so let's say it's a $500,000 pool. So the state will allow you to qualify for Medicaid assistance from the state and protect a pool of money for $500,000 before they'll start helping you. So what it does, it says you don't have to go down to $2,000 because you bought the long-term care policy and you've exhausted that resource. We'll let you qualify for Medicaid assistance and still keep $500,000 because that's the amount of long-term care benefit you bought. What are the cons? And the cons are big. The annual premiums, except for one provider that we're aware of, there are no longer pay to 65, 10 pay, or single pay. They're all life pay. And it says here possible rate increases. We're telling people that if they're 65 buying a traditional long-term care policy with a life pay premium, it's not possible that there's going to be rate increases. It's probable, and you need to plan for it. The rate increases on traditional long-term care policies over the past 8 years have been dramatic, going up 30, 40, 50, 90, 100% increases in premiums. Now, with that said, a lot of those policies are some of the best policies that were ever issued. Before your clients go ahead and make a change on an existing policy just because they doubled the premium, we need to do an analysis for them. Because usually, even with that doubled premium, what they're getting for what they're paying is of substantial value. Yes, it's horrible that your cost doubled, but you still have a great deal, and more likely than not, we couldn't replace it with a cheaper plan today if we tried. So we do advise people to expect premium increases, but if they're getting them, and it's an opportunity, that's another opportunity to get your clients to come in and talk about this. Do you have long-term care? Have your premiums been going up? Let us help you answer questions about that. Should you keep the coverage? Broadly speaking, my experience has been they should. They should not lapse that thing. If they can afford to pay the premium, keep paying the premium. And if they can't afford the premium, help them evaluate what the premium stabilization options are, because every carrier prior to a rate increase says, here are the things you can do to prevent your premium from going up as much. Reducing your inflation rider, eliminating the inflation rider, extending your elimination period, those types of things. So, and the great one with traditional long-term care, you either use it or you lose it. It's like car insurance. If you go your whole life without having a car accident and pass away, they don't refund the money of car insurance premiums you paid your whole life. It's the same with traditional long-term care. They don't refund your money. You don't use it, you lose it. And you can shell out a tremendous amount of money, and if the spouse dies, falls over dead from a coronary instantly, well, you're not getting that money back. Linked benefit products. You get a 100% return of premiums. When you die, the death benefit pays out. This is linked benefit. Sorry, I got my order wrong on my slide. Sorry, linked benefit products. Many of these products will guarantee you a 100% return of premium. MoneyGuard and several of the other products, you put a $100,000 single premium in, and you change your mind. With MoneyGuard, 5 years from now, you change your mind, you get 100% of your money back. No questions asked. Is your client better served by letting $100,000 sit in a CD paying them 1.5%, $1,500 a year, which you're going to pay taxes on, or leveraging that $100,000 into a $300,000 pool of long-term care benefits? It would probably cost them $3,000 to $4,000 a year to pay premiums on. But say interest rates spike in the next 5 years and they can earn 10% on that $100,000. Well, give me back my money. I would rather have the income. There's a little bit of death benefit. Again, these products are not designed to maximize death benefit. Quite frankly, they're designed to minimize the death benefit. Over time, the leverage of the death benefit is minuscule. The benefits are guaranteed. They can't change the benefits on you in the future. They're very simple to understand. You have one in done flexible or flexible premium option, and your premiums can't go up either. So if you signed up for a 10 pay, they can't raise that premium. Everything's guaranteed. The premiums are guaranteed. The benefits are guaranteed. Your surrender values are guaranteed. And you can transfer money from an existing life insurance policy to fund the plan. You have a client that's got $500,000 of whole life out there with $300,000 of cash value. In reality, they have $200,000 of life insurance. The rest of it's their own money. You 1035 that into one of these policies, and you can leverage that $300,000 maybe into $600,000 or $700,000 of long-term care benefits, $600,000 or $700,000, a death benefit that's, probably close to what they have in the long-term care policy, at least initially. And again, it's a very efficient use of cash if they don't need that whole life policy anymore. What are the cons? Lump sum investment may be required. And once you get over age 70, and actually, again, market is evolving. They're getting a little more competitive, 71, 72. But generally speaking, over the age of 70, they don't look so competitive. Accelerated benefit riders. Again, you have a client that has a specific need for life insurance. You can provide a guaranteed benefit, guaranteed rate, a moderate long-term care benefit. But if you have a client that's buying $1 million of life insurance for whatever purpose, and you put a 4% accelerated death benefit rider, that's $40,000 a month. Now, it may not have an inflation rider, but if your client's 65 and normally a generous long-term care plan would be $10,000 a month, we can afford a whole lot of inflation to get to where we have to be at $40,000 a month to lose the inflation benefit. And you have flexibility of funding. They're universal life policies typically, or whole life policies. Funding in whole life is not so flexible, but in universal life, you have flexibility of funding that policy. As long as the policy remains in force, the long-term care benefits remain in force. The cons, well, when we're talking about a guaranteed death benefit, a GUL product where we're guaranteeing the death benefit, not really focused on cash value, you're going to have low cash values. So you don't have the return of premium option per se that you have in the linked benefit options. Now, that's not to say if we have a client who's doing max funded VUL, everybody knows that's my favorite, and they're accumulating substantial cash, you can still put the long-term care rider on it, have high cash values, have supplemental retirement income, and have a long-term care benefit. Makes for a nice long-term financial planning solution. Long-term care qualified annuities. You can 1035 life insurance or annuity policies with gain to a tax-qualified long-term care annuity. This is the annuity I was talking about that came into being in the Pension Protection Act of 2006. Before replacing your annuities to a 1035, you need to consider whether there are surrender charges or existing on the existing contract and any new surrender charge schedule on the new contract. Well, I'll guarantee you there'll be a new surrender charge on the existing contract in these annuity transactions. But if the client's sitting there and they've got an annuity that they put $100,000 in, it's worth $200,000, they know they're never going to touch that product. They're going to leave it to their heirs. Well, they might as well use it and leverage up some long-term care benefits for themselves. Same, you can also do with whole life, universal life cash values. You can access the gains income tax-free to pay for long-term care premiums and or expenses, and you can leverage cash value into a multiple for long-term care benefits. Some of the annuity products, okay, I got someone that's got a $100,000 gain and a $200,000 annuity. They can't walk. Now, there'll be some, on the annuity, there'll be, excuse me, a 12 to 24 month holding period before you can start taking the distribution. But they can start taking those gains out, income tax-free, to cover long-term care expenses. Some of the annuities will take the $200,000 and leverage it up to, say, $300,000. Now, there's going to be some element, you know, if your client's already in a wheelchair, they won't let them buy the product. But if your client is in reasonably good health, they can walk, talk, and take care of themselves. Even the annuities will offer some component of leverage. And it's the same thing. If you never use it, the annuity value passes to your beneficiaries as any other annuity. As you know, the gains in the annuity become taxable to the beneficiary. And there are options with qualified funds. I won't get into those too deep, but One America has an option, and it's more of a perception as opposed to providing any type of leverage. They have a thing where you can put a lump sum into an annuity that is annuitized over 10 or 20 years. They take the net distribution, they calculate whatever that is, and they use that to fund a whole life policy that's going to have long-term care benefits with it. Now, there's some ambiguity as to whether this is going to come under DOL. Well, and I'm pretty certain that this one will come under DOL and the fiduciary standard. I've not gotten a lot of details on how that's going to be handled. But there's with the qualified fund options going into a life insurance policy, I believe you'll have some DOL issues, source of funds issues. So what works best for you? It's too important of an issue to be left to chance. We are full service financial professionals, and this is me presenting to the consumer. We can help determine which solution is best for you. Again, I got no issues with providing the best solution I can to my clients. Never have. That's how we've always practiced. Decisions cannot be made in a vacuum. You can't just go in and say, hey, I'm selling this red shiny product today, and I'm going to talk to every one of my clients about it, and that's the only product I'm selling. As we've shown in this presentation, there's a spectrum of solutions out there. We need to sit down, do good discovery with our clients, and find out which of the products is best for them. Here at CORE, we help with that analysis to help find the best solution for your client. You have questions, we can help. We say that to the client, and I'm saying that to you as advisors.
And we do have a question. We have a question. Do you need a securities license for LTC annuities?
No, you do not. They're not variable products. What you will need is you're going to need whatever your state annuity training regs are, as well as whatever your long-term care training are. So you will need the health component of your life and health license, and you'll need to complete whatever long-term care training your state. We can assist you in finding out what those requirements are.
Awesome. That's the only question we have so far. Does anyone else have any questions that you want to type into the chat box? I think that might conclude the presentation today. Thanks, Rob.
I'd just like to follow up. Listen, we can help with the presentation. We've got materials and handouts that you can provide to your clients when you're meeting with them one-on-one to broach the conversation. We've got materials or mailings if you want to send a letter out to your database or your clients. If you want to work, the seminar is available. Again, if you have strategic alliances or you're in a professional firm such as a law firm or a CPA firm already, we have the resources to help you pull together and make this presentation to your clients one-on-one or in a group setting. So reach out to your relationship manager, find out how we can help. This is my belief is that this is going to be a tremendous growth opportunity for us as advisors. I think as people who are doing the best thing for their client, I think we have an obligation as advisors to have this conversation, the long-term care conversation with every one of our clients. And I would document it as well, that you had it and the client declined. But I think it's an opportunity on many levels to increase business, deepen the relationship you have with your client, do the best thing you can for your client, and be a true financial advisor. Thank you, Allie.
A few more questions just came through. So we'll ask those really quick. Yes, you can get a copy of the presentation, and you would work directly with me. So reach out to your relationship manager, or if, Rob, you click to the next slide, my email address is there. So anyone can reach out to me. And again, the disclosure here is that you need to just make sure that the presentation is approved through your respective broker-dealers to make sure that that's okay to use as any marketing materials. I can take any marketing materials we have and work with you to put your logo on them and cater them to you and see what you might want to do, whether it's via email or doing a direct mail, anything like that. Another question, Rob, that we had was, let's see. Can you address connecting with estate planning firms to meet with their clients? Go ahead, Rob, or let me know if you want me to go.
No, go ahead.
I was going to say that one of the things I can also help you do in your respective area is find the right places to do some networking. And if you don't already have any of those relationships built, that can be a great way to do it. I just went to a meeting last week here in town and met 2 different estate planning law firms, and I have meetings with them. So it's just basically building those relationships up if you don't already have them formed. If you already have them formed, it's talking about doing these joint presentations, workshops, seminars, however you want to label it. And then, Rob, if you want to give your feedback.
Yeah, if I had a relationship with an estate planning law firm, or I had a relationship with an accounting firm, or any type of other strategic alliance like that, the first thing I would approach is I would provide it as a lunch and learn for the attorneys themselves or for the CPAs themselves. So, and we have done that in some of our CPA relationships. We've gone in and have future presentations scheduled, because they, as tax professionals and as estate planning professionals, they need to know the content of what's in here because it's absolutely relevant to both of their practices. So where I would start is one, offer it to them as a lunch and learn. Say, let's bring the staff together, the people that you need to know, bring in some sandwiches and do the presentation to them. Then I would then say, now, what can we do to start providing these workshops as a value-added resource to your clients? One of the relationships we have here locally is with a large estate planning law firm. They opened up their database to us. They had 12, well, every time they tell us how many people in the database, it grows, but they had 12,000 plus estate planning clients. They allowed us to present. They do lunch and learns, and they do what they call question and answers for their clients, where the clients can come in and ask them anything. And they let us come in and be there to address long-term care needs. And we've had a great deal of success with that relationship. So I hope that helps.
And I think that should answer everybody's questions. Again, if you have any needs, you can go ahead and just email me at apeters@coregroupusa.com. My name's Allie, and I'll be happy to help you with any of the marketing materials, etc. Thank you for your time today.
Thank you, Allie.
Bye. Have a good one.